Good morning. Thank you, Jim. Thank you, Nikki. Yes, my name is James Wood. I'm the owner of Revolution Wealth Management, and I've recently joined Innovation Martlesham, looking forward to meeting as many of the fellow business owners as possible. It seems like a great place to work and grow your businesses. I formed my company 7 years ago, having worked within HSBC and Barclays corporate financial advice teams for over 10 years. And I specialise in providing financial advice to entrepreneurs and business owners on their journeys. So today, I want to talk about how to extract the maximum value from your business using financial planning, employee benefits and payroll solutions. We'll look at business growth and how we can support companies at every stage of their growth, the successful financial planning journey through 6 key stages, some end-of-year planning tips, specifically around allowances, and valuing your staff, recruiting and retaining, and using things like auto-enrolment and employee benefits to your benefits. So I try to look at financial planning as each person's individual financial journey through life. My logo helps to represent how you might build wealth through life and some of the key points along the way. So, for example, in your 20s and 30s, you may be looking at your first house, your first job, and should be looking potentially then at creating an emergency fund, some income protection, looking at opening ISA accounts and maybe starting a pension. As you move through your 30s and 40s, maybe marriage, owning a house, having children. You tend to be looking at mortgage and potentially protecting that mortgage, protecting your young family, and maybe savings for children and ensuring you've written a will. Through 40s to 50s, you probably have an established career at that point. Your children may be leaving school, and this might be a point where you can afford to increase looking at your pension funding and looking towards the future, longer term investments and potentially private healthcare. Into your 50s and 60s, maybe thinking about retirement. You may have aging parents, your children might be at university or requiring a first house, so suddenly there's a number of other financial pressures on you. Retirement planning options and more specific plans around retirement come in at that point, potentially assisting children with their plans and considering long-term care. Hopefully 60s and 70s, or maybe before if you're lucky, consider retirement, but also considering your legacy through estate planning, your key thing around pension withdrawal options and how you use the assets you've built through life to actually enable you to enjoy, which takes you through into your 70s and looking at how you manage your assets, how you pass wealth through the generations and on to the next stage effectively. And the idea being this is a cycle. You're hopefully passing wealth on through the generations, and then the circle continues. From a business perspective, I've tried to align the 4 key stages of business with business owners' needs mapped against how financial advice can support you. So this slide really in the centre gives you an idea of what generally will happen with a business, going from start-up to growth to maturity to exit. The blue circles show some of the pressures and some of the thoughts that generally will be in business owners' minds. At the start, where you're looking at startup loans and cash flow, requiring capital investment, and then through to contingency planning in the growth stage and expansion and restructuring. At each stage, financial planning allows you to support at each level. So initially, we often look at some sort of protection on the business owner as they begin, and as you build up value, identifying the key people in the business whose loss would be a significant issue. As the business actually begins to accrue value, often there are more than one shareholder, and you can look at protecting each person's shares. when we look towards maturity and actual, some profitability, it's looking at the reinvestment of those profits and whether you use corporate or personal investments, how to extract money tax efficiently from the business, looking at profit extraction and diversification and retirement planning in general through pensions and investments. And also, as you do acquire staff, if you grow, it's very much looking at employee benefits, what your succession plan is, whether there's going to be a flotation and how you actually exit. And at that point, we often help with wealth management and inheritance tax planning along the way. So really every stage of business, we can support clients on their journey. We've built a six-stage financial planning journey around really looking to build a clear plan for my clients. And it starts with your aims. So what are your aims? What are your short-term goals? In the next 5 years, what are you looking to achieve? But also mapping those towards your long-term ultimate goals to make sure that they do fit. What is the times plan? What is your future legacy that you're trying to build potentially within your business? P is for plan, to build a financial plan to make sure that you protect what you're building, to leverage in the most efficient way. And obviously, once you're creating profit, how you extract that profit leading into retirement. P is for profit, build your plan. How do you proactively succeed and generate the income that you require? And whilst I don't advise specifically on that, I work with a number of people who help with mentoring, coaching, and helping business owners to grow outside of normal, financial planning support. E is for efficiency. Ensure that your plans are tax efficient. It can make a significant difference how you structure your wages, your earnings, the way you extract money from the business can make significant difference. And good planning is required at that stage, and this will change over time and with legislation. A is for assess. We work very closely with clients to evaluate and evolve with them and make sure we're measuring the progress towards those end goals. We use cash flow planning and asset planning so we can map out not only your business goals, but if you own properties or you have other assets, we can build them into an ultimate cash flow plan so that you can see at which stage you may want to start releasing some of those funds and just giving peace of mind that you can achieve that. Finally, R is for retire / relax. Exit on your terms. When you set up a business, make sure that you have the end in mind and that you are leaving on your terms and that you're maximising the assets and the value that you've created in your business to give you financial freedom so that you can enjoy later life in the way that you want to, and also look to pass a legacy on through your family if that's part of your wishes. And as I say, extract the maximum from your individual journey, circumstances and skill sets so that your best life can appear ahead of you. So I just want to talk a little bit now about some tax year end planning. We're obviously in mid-January. The tax year end is still a couple of months away. However, it's important to start considering these things and looking at seeing if you can take action. There are a number of allowances which are annual allowances, and some are lost forever at the end of each year, and so it's just making sure that you are aware. We try to arm our clients with all the information that you could need to choose to make a decision should you wish to. So key areas I'm going to talk about are the basic rate allowances and dividends, ISA allowances that are available, the way pensions and pension contributions work, some other tax efficient investments, and then finally inheritance tax and capital gains tax. So just probably a recap for most of you, but we all have a personal allowance, generally of £12,570 available. Making sure you maximise that is a sort of no-brainer at the outset. But there's various other planning points that you need to consider. Obviously, there's a move to high rate tax at just over £50,000. A key point that those who are able to pull more out of the business need to always be aware of is that if you do earn over £100,000, then you do start to lose your personal allowance at that stage by £1 in every £2 above that level. So some really careful planning is required at that stage, because you can effectively be taxed at 60% between 100 and just over £125,000. So some key planning, pension contributions can help. There are various ways that you can offset against that. If you do have a limited company, then it's important to note that the first £2,000 of income from dividends is no longer subject to tax, and then you're taxed at 7.5% up to the high rate tax threshold. So it's worth considering dividends as part of your earning strategy. In terms of ISA allowances, this is a key government offering to you. You have one ISA allowance each year. You can invest up to £20,000 in this tax year, and all future investment growth within that ISA will be free from personal income tax and capital gains tax. You can't carry your allowance into the next year, so if you don't use it by the 5th of April, you will lose it. There are two types of ISAs. There's the cash ISA, which is effectively a savings account which is wrapped in an ISA, and then a stocks and shares ISA, which has an investment element to it, from a relatively cautious investment through to higher risk. You can still split your allowance between the two types in any way you wish, but it's important to sort of check your existing cash ISA holdings if you have them, and make sure you are getting the best available rates, but also to make sure that there are no penalties if you were to move them. At the moment, savings rates are as low as 0.3, 0.5%, and with inflation running at 4 to 5%, money sitting in savings accounts is effectively losing quite significant value every year. Interest rates are not looking like moving much at the moment. There's some whispers, but they're highly unlikely to shift dramatically into a point where your savings are working really hard in the bank, and so therefore it is worth considering looking at stocks and shares ISA if appropriate, and if it's a longer term investment. When it comes to pensions, I think this is one of the sort of grey areas for a lot of people. It's a dark art. People probably aren't always aware of the opportunities within pensions. There's been a considerable freeing up in this market over recent years, and it's become a far more attractive way of saving for your retirement. First point to make is sole traders and partnerships or individuals get tax relief on your personal contributions of up to 100% of your earnings, salary and other earned income in that calendar year, or in that tax year. Sorry. It's obviously an opportunity to receive your tax back. So if you pay £100 into a pension, you'll receive £25 in basic rate tax, and potentially another £25 in high rate tax relief if you apply for it. So there's some significant benefits in comparison to traditional savings. If you have a limited company, you can offset your company contributions against profit. So they are an allowable expense and can reduce your corporation tax quite heavily. The annual allowance for tax relief is £40,000 at present. One thing to note, if you are a higher earner, that you do have to take into account that if you do earn over £240,000 in total, including pension contributions, you do start to lose your annual allowance without careful planning. So if anyone needs to discuss that type of area, obviously happy to discuss. Final point really on this is that the lifetime pension allowance currently stands at £1,073,100. This does include calculated value of defined benefits. So, if you do have a final salary scheme, it's important to understand what the value of that is in line with your other sort of pension planning. There are opportunities within final salary schemes to consider transferring. It needs to be under certain conditions and for certain reasons, but it is an area that we can advise on. There are other sort of, I suppose, less traditional investments that we provide to clients that also offer tax relief beyond pensions and sit mutually exclusively from pensions, so you can take advantage of these as well. So enterprise investment schemes and venture capital trusts offer tax relief of 30% on the initial investment. Maximum annual investments are up to £1 million in an EIS and £200,000 in VCTs. You can invest in a wide range of things. It's traditionally seen as a very sort of high risk area. However, increasingly there are schemes which provide a lower risk environment, so you can take advantage of the tax relief and some of the other planning opportunities without necessarily taking significant risks. We have a panel that's very well researched and resourced, and it allows us to advise right through the risk scale on these areas. Key thing to say is that this is the time of year when a lot of opportunities arise in the EIS and VCT market with tax year approaching. There are various other planning opportunities available within these, which are things like deferral of capital gains. There are some recycling investment strategies that you can use as well, so we tend to sort of walk clients through those. Finally, inheritance tax and capital gains tax relief are available to you as well. You can gift up to £3,000 in this tax year, and it will fall outside of your estate for inheritance tax purposes. You can also use 1 year carry forward, which means a couple can gift up to £12,000. So it's not always realised that that's available to you. There are various other inheritance tax planning mechanisms we use, but that's a simple starting point. You can also make gains of up to £12,300 of investments or property without incurring any capital gains tax. So if you are thinking of selling some assets and realising gains up to that level, there may be a benefit in doing so before the 5th of April. So I just wanted to give you a little flavour of some of the ideas planning-wise that you can use before tax year end. I'm just going to move on now to my colleague, Caroline Humphries, who will give you an update on the mortgage and general lending market. Caroline, over to you.
Hi, can you hear me okay?
Yes.
Hi. Hi everyone. I'm Caroline Humphries. I'm the Mortgage and Protection Advisor within Revolution Wealth Management. So I specialise in providing our clients with residential mortgages, remortgages of existing properties, and buy-to-let mortgages, either be it on an individual basis or within a portfolio for portfolio landlords. We're seeing obviously unprecedented rates at the moment, still very low in the market, even though there has been a slight rating increase with Bank of England. Rates are still low, so if you've got a loan to value of less than 60%, then these can still be found at down near the 1% mark. So it's really important to look at your existing deal and see when it's coming up for renewal, if it's within a fixed period, and trying to lock in one of the low rates that they're offering now, especially over like a 5-year term if you're planning to stay where you are, and lock that rate before things start to rise. We are backed by St James's Place, as James has already mentioned, and what that does, that enables me to get a really extensive range of access to mortgage lenders and the rates that they're offering. So I'm confident that I can find the most suitable rate within the market for you. They also have a number of exclusive rates that St James's Place have negotiated directly with the lenders. So between the two, it's an attractive offer there. But I just wanted to point out today just a couple of changes that I've noticed recently that may be of benefit, particularly to business owners. Is that in the past, lenders have been looking at salary and dividend as a way of applying a multiple for your maximum borrowing for a limited business owner. But now they're opening this up to consider more of retained earnings within the business, especially as more and more people are trying to tax efficiently take their income. And so a number of lenders are now looking at share of net profit after corporation tax plus salary instead of salary and dividends. So I've seen this work in terms of really opening up the amount of borrowing a number of my clients have been able to attain. And secondly, we are up to speed and specialising in all of the aspects that lenders now require with regards to anyone who's received any COVID assistance. And there's a number of lenders who have really got some good support in place to offer support for increasing the amount of borrowing if you have had an impact in COVID in the last 12 months, you have taken any bounce back loans or grants, and they will look at ways of extending the borrowing by either not taking into account the latest year's figures and using the previous years, or using a projection of that. So any mortgage requirements, I'm here and would love to support you.
Thank you, Caroline. And finally, I'm just going to talk briefly about employee benefits and how you can help recruit and retain staff. It's not retrain staff, it's retain staff. Apologies for that. Basically, I think employee benefits is one of those things that some business owners will see as something they have to provide. What I found is that the companies who do take it seriously and do look to provide value to their staff have better engaged staff, and generally it does support the business in a positive way. Just a brief recap on auto enrolment, because this has been around for a while now, and most of you who have companies where you do employ people will be aware of it. But as a recap, it's quite complex as a solution. The scheme quality, the different providers, does vary greatly. And what you offer staff does reflect on their feeling of value, if you just tick a box, or if you actually provide something that has a slightly more all-encompassing nature to it. Auto enrolment does affect all businesses with at least one employee. So if you do employ at least one person, you do have to, if they're an eligible worker, auto enroll them, and there are mandatory minimum contributions for both the employer and the employee. There are some strict rules you have to apply to. There are potentially fines for non-compliance, and we help guide you through that process and just make sure that you are fulfilling your obligations, and as I say, trying to add value to your staff in amongst the process. Alongside that, there is this group death in service benefits that can be wrapped around the group pension. There are private medical insurance options as well. These don't have to be costly, but they can really provide valuable staff benefits. So at that stage where you are looking to grow and recruit and retain staff, these can be valuable things that you can offer at these points. So that really ends my part of the presentation. Thanks very much for listening. We're available should you wish to discuss any of those areas in a bit more detail. We try to build bespoke plans for all clients, because one size doesn't fit all at any stage. So if you'd like to find out more about what we've just talked about, then please do get in contact. But for the moment, I'll pass you on to Louise Rogers from Contador Accounting.
Good morning, everybody. I won't hold you up too long on this because I'm conscious of time and people needing to get back to their day-to-day lives. Just to introduce ourselves, I'm Louise Rogers, and my colleague Alison Willett will be talking to you about payroll solutions and the importance of that service over the last few years. If we can move on, please. Just a quick introduction to our business. Contador Accountancy Services was created in 2014, and we are based here at Columba House in Industrial Park. I was joined by colleagues John Matthews in 2017, Claire Boswell, and latterly Alison Willett as our payroll services manager. Our payroll services have developed hugely over the last couple of years, especially during this pandemic time, and continue to be one of the most important services that we provide. And I'll just like to hand over to Alison, who's going to talk more about the importance and significance of payroll and employee benefits over the last few years.
Thank you, Louise. Good morning. My name is Alison Willett, as Louise says, and I'm Payroll Services Manager at Contador. I process payrolls for clients on our BrightPay software, and I also remote into client payrolls that have in-house payroll systems. Previously, I had a client portfolio of just under 300 payrolls and a team of 6. So we had a vast amount of different payrolls, including schools, doctors' practices. We ran an international airline, and I also processed occupational pension schemes. Payrolls in numbers, probably from a director's payroll up to 1,200 employees, probably paying about 40,000 employees per month. So over the past 5 to 10 years, payroll has dramatically changed with the introduction of real-time information, auto-enrolment, GDPR, and the most recent change in terms of the CJRS, the Coronavirus Job Retention Scheme. So if I just go on to a few duties, so moving on. Okay, so real-time information, the impact of that is when you make payments to staff, you have to inform HMRC by a full payment submission. And that has to be done, I'd say, every time you make a payment. And also the employment payment summary, an EPS, needs to be sent in if you have any statutory payments, maternity, paternity, etc. And also we've found that some clients have had slight problems in the fact that if you have employment allowance, you do need to send an EPS now in April. Some clients didn't realise that because it did used to roll forward, but now you do have to apply for that employment allowance each April if you are a smaller company. The other changes that have come in, and I think James has briefly talked about auto-enrolment and pensions. If you're a new employer, particularly if you're setting up a pension scheme, you do need to have a little look and see what's out there, what sort of staff you've got. And we are seeing a little bit more that employers are looking at their pension schemes and maybe thinking, well, when I started out, I had 5 employees, now I've got 100. Should I be looking at my pension scheme and reassessing? Moving on to payroll software and outsourcing payroll, which of course is what we do. Payroll has changed dramatically over the years regarding the fact that we used to chug out lots of pay slips and payments. I remember taking payments to the bank many years ago. Now everything really is done on a digital basis, pretty much, where we have cloud systems and payroll portals. And I'm just going to talk a bit more about that in sort of my next slide. Contingency planning, I think the pandemic probably has brought to the forefront contingency planning for payroll. It has always been important because, let's face it, the primary purpose of payroll is to pay people on time and accurately. And as the payroll has become a little bit more complex over the years, it's very important that contingency plans are in place, particularly, if people were going off sick, or, you need to have somebody in place to make sure that the payroll is processed and other people can actually step into that role. And I do remember going out in a previous role where somebody had sort of departed, and we got a panicked a telephone call saying, oh, can you come and run our payroll? So I had to sort of drive to the clients and go in blind and try and pick up their payroll and process it. So, the employees got paid. So, employees do get rather upset if they don't get paid. So contingency planning is very important to making sure that, you do get your payroll out and employees are paid on time. So moving on, I'm sure that many of you probably think, oh no, furlough, don't talk about furlough, we don't want to ever hear that word again. But obviously the the job retention, the CJRS, has helped to save many jobs and support employers during the pandemic. But I'm sure that we all waited with bated breath in December, thinking, are we going to go into lockdown again? Is furlough going to return? It's certainly put a lot of pressure on payroll departments, and speaking to some of my peers, certainly at the beginning, making, spending time working out furlough calculations. Not only that, then the flexible furlough came in. So the payroll, the pressure on payroll and staffing was quite intense at that particular time. So waiting with bated breath, it didn't come in, but now we have the prospect of inspections, and it's predicted that HMRC are going to audit lots of businesses, particularly small businesses, to ensure furlough payment claims were legitimate and accurate. So many company directors will need to provide records and documents for inspection, and you will have to take practical steps to ensure that they are compliant if HMRC selects you for audit. One thing that did return on the 21st of December, and that was the statutory sick pay COVID-related illness reclaim. That's returned 21st of December, which having stopped at the end of October. And if employers are eligible, so for example, if you've got fewer than 250 employees at the 30th of November 2021, and the PAYE payroll system as of the 30th of November 2021. So that has returned. So if you have anybody that has gone off sick from the 21st of December, then you can make a claim. This is a temporary support for employers, but I do think it's probably going to go on until the 5th of April. But we never know with the changes. I think every Monday morning I look on the system to see if I've got any changes coming in for payroll, and what the government have decided to change. So moving on. So we're just going to have a quick look at what the future holds. Paperless payrolls and hybrid working has been sort of in the news quite a bit. People working from home, people partly working from home, and how that sort of affects payroll, and paperless payroll. Many years ago, I do remember HMRC were sort of talking about the fact that they may sort of be processing payroll themselves, and we all thought, oh, that's probably not ever going to happen. But the way we've sort of moved on with payroll, and particularly on clouds, and everybody being able to put their sort of information into computer systems, like, for example, changing their own addresses, booking holiday online through their own portal. We are certainly moving towards, paperless payrolls, picking up pay slips, picking up P60s via a portal, as opposed to, having, printed pay slips, etc. So that's so we'll just move on a little bit now to the changes from this, because I'm aware of the time. So we are looking at a few changes coming in, particularly the health and social care levy from April 2022. So the national insurance threshold and rates of national insurance are set to rise by 1.25% from April 2022, as part of the government's introduction to the healthcare and levy. So this will also change from 2022-23, to the point where we were looking at employees that are above state pension age that will be coming into the levy, and it's also going to be sort of put on payslips as a separate item. There's also going to be a freeze in the PAYE, so we won't be having any changes to personal allowances, and the base rates are going to be frozen. And also there is a proposed the removal of the temporary working from home rule from April 2022, where employees who work from home due to COVID will no longer be able to claim the £6 per week tax relief, and instead they will be asked to eligible under section 366 of the income tax rules. So payroll hasn't always been recognised as an industry in its own right. However, in recent years, there's been a push for payroll to be recognised as such. And although life as a payroll professional can be particularly challenging, especially in times of significant external change, it is very rewarding. And there is one thing for sure: in payroll, change is constant. So thank you very much. And if you would sort of like to speak to us about payroll, please get in touch. Thank you.